Okay guys, in this video I will just recap what we talked about in the initial classes about investment and focus on what's important when you need to consider why companies make investments and why they need to borrow money for these things. First of all, there are different types of investment. Investment can focus on tangible assets such as machinery, buildings, production equipment, and vehicles. Principles for investment is intangible assets, that is product development, patents and goodwill, and financial assets, bonds and shares are the same. So assets, if an investment is profitable, is what we're actually going to focus on in this class and in these videos, is to focus on whether we can make more money from this investment or whether it would be a better deal for us to actually just go out and borrow the money. Borrow the money and put them in and invest them in stocks instead of investing them in intangible or tangible assets. But to make investments, when you invest in vehicles, etc., you need to figure out, okay, will it be actually a good idea for the company to actually invest in these vehicles, or will it be a better idea to just invest in something different? Therefore, we need to know, okay, how can we make an investment calculation? And there can be several reasons for investment. First of all, replacement investment. Replacement, that is when a machinery needs to be replaced, if the machinery might have been outdated, or if we have seen a decrease in production because the capacity of the production facility is not running as suitable as it could be. Expansion, that is whether we are in a situation where we need to expand our capacity and therefore maybe also buy a second machine or third machine. Rationalization, that will be focused on lower cost of production. That could be a case where we find ourselves in a situation where we can actually reduce cost if we actually invest in this machinery. Forced investment, that will be if, for example, we have new legislation that provides us with the information saying, okay, you need to invest in this machinery right now. Welfare investment is more focused on investments related to social society. And here we have for example, the investment, the relationship between capacity and activity. We will not go that much into detail with that right now. But when is an investment profitable? We need to set up an investment calculation. If we look here, for example, the moment when you actually invest in machinery, you will be forced to put out a lot of money or to borrow that money and take it out as a loan, but you're forced to be, this we will normally call year zero. Then we have several years where we have a positive cash flow, where we have money coming in, money that we wouldn't necessarily see if we hadn't made the investment initially in year zero. So depending on how many years this will actually be possible, we will actually be focused on providing year 1, year 2, year 3, 4, 5. So that will be positive cash flow and negative cash flow in the year where you made the investment. The lifetime period, it depends. It is whether physical or technical lifetime, how long will we actually be able to use this machine. The scrap value, which you'll also be focused on in this class, is in talking about investment, is the estimated selling price at the end of the investment period. This can of course be zero, but it can also be several hundred thousand, a million, etc. It depends on whether someone will actually be interested in buying the machinery at the end of the usage. Projected income in the outgoing payments, this is, for example, the positive cash flow, which would be coming in at the beginning. You can see an example here where it's indicated that the investment net present value indicates the total present value of the investment expected reception and payment at a given discount rate. Here we see an investment for 1.8 million, and we see positive cash flow in year 1, 2, 3, 4, 5. And then in year 7 you see, or in year 5 you also see, including of course a positive cash flow of 400,000, but also a scrap value of 300,000. Therefore, we suddenly found ourselves in a situation where we are actually making money. So if we put it up here, we set an example here where we decide, okay, in order to make this investment profitable for us, we expect at least a return on investment of 12%. This means that if we didn't make this investment, we will still be able to put the money, this investment money will be able to put in stocks of another company, or to invest in something different, and we would be more secure. In this case, we're actually taking a risk. So we invest 1.8 million, and we argue that we can get a scrap value of 300,000 after year 5. Yearly earnings will be 400,000. So we see the net cash flow here, and then we see this discount rate, the factor, which in year 0 it's 1, and afterwards it will be less. So we see the present value and net present value in this case will be below 0. This will mean that if we put the discount rate at 12%, it will actually provide us with a negative result if we made the investment, at least if we expect to have the discount rate of 12%. So in this case, and we also see here, we can actually see that the interest rate that we expect, the discount rate that we expect, will actually provide us with a negative result. In that way, we'll actually be forced to maybe reconsider the investment, or maybe reconsider the discount rate. Otherwise, we'd actually lose money in the investment at this present time. You can also use it when you calculate it in Excel. When you calculate it, I'll also explain in a video. I'll also explain, of course, in class what you're supposed to do. But you are supposed to use the sum function and you're also supposed to use the potence function in order to actually calculate whether or not it will be a success for you to make this investment.